Welcome back. Carin, you view your current posture as defensive with a focus on stability and quality balance sheets. What should investors be looking for?
Sure. I think it's really critical for investors to focus on that credit quality, that balance sheet that you mentioned, because in a higher interest rate environment, we're going to see some of the stress that it might present for companies in terms of their ability to continue to fund their business. Funding costs are rising, so companies that are able to self-fund, companies that have strong cash flow, are the ones that are going to be able to weather a economic slowdown much better.
And what categories are those companies likely to be found in?
So we do think that there are opportunities in consumer staples where you're seeing some companies that are dealing with some of the cost pressures better. Companies that have pricing power will do better. We do think that some of these companies have good dividend growth. So for now, as you mentioned, we will continue to stay more defensive. I do think that dividend growth stocks, from a valuation standpoint, are actually pretty well positioned here. They haven't performed as well for this most of this year because it's been much more favorable for growth stocks this year. So I think the valuation differential for dividend growth is actually quite attractive here. So beyond consumer staples, you are going to find some of these in the healthcare sector. And I do think that if you can find some good dividend growth stocks within utilities, that could be attractive. And don't forget energy, which is right now seeing some momentum in terms of support for oil prices. And there are some good companies with very strong free cash flow yields there.
Thanks, Carin. Get breaking news as well as timely analysis daily at QZ.com.